Hey guys, today we're talking about Q4 earnings season preview right here on the Tatro Show, coming up right away. And this is always really exciting for me. Sit down, buckle up. We're going to talk about the 4 or 5 points, 5 most important points that we see coming in with Q4 earnings season, which has already started. So Q4, fourth quarter of 2020 kind of rolls into January-ish at some point. And now these companies are reporting earnings. We want to see how they did. Let's get right into it. Remember, if you're watching on YouTube, Facebook, Instagram, wherever you're watching, take a sec to like, to subscribe. We want to see you there. We want to get you as a fan. I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisory Group. The trends. Okay, the expected earnings are expected to decline for the fourth straight quarter. That's the first thing I want to point out. So consensus expectations were for roughly 8.8% decline in the S&P 500 earnings. So that compares with earlier declines, Q3, Q2, Q1, that were much more significant, 15% in Q1, 32% in Q2, and 6% in Q3. So we're expecting a smaller decline. Now, the S&P 500 revenue, if we're looking at the top line number, remember, earnings, bottom line number, revenue, top line number. The earnings is after all the expenses. The revenue is the top line number. The revenue is expected to increase 0.4%. So that compares to the 1.1% decline expected at the start of the quarter. So in other words, the expectations are a little bit higher. Remember that revenue increased 0.9% in Q1 and fell pretty dramatically, 9.2% in Q2 and 1.1% in Q3. Okay, so we're expecting a slight gain in revenue and we're expecting a decrease in earnings. Why would that be the case? Obviously, expenses are higher. You got a lot higher fixed costs. You get less top line revenue. Your earnings are going to come down. Now, the estimates bucked the trend and rose for the second straight quarter in Q4. So this is the internal kind of adjustment. So the 5 and 10-year average are roughly to see declines of about 4.5 and 4.2%. And this is the bottom-up consensus for Q3. However, the positive revision momentum did come in the wake of a 17% reduction over the course of Q2 and Q3. Let's take a look at which sectors are expected to see the biggest gains and the biggest declines. Let's start with the declines. What's an obvious one? Energy. Energy earnings are going to be down a lot. So we saw 28% reduction in oil prices. So we're expecting to see a big decline in earnings. Probably something like industrial sector, not as much, but we're expecting somewhere around 35%. If we take a look at airlines, consumer discretionary, they're going to be down, 18 or so percent. Hotels, restaurant, leisure, they're going to be also a big drag with automobiles, multi-line retail, and household durables are also expected to be increased declines. Which ones are going to outperform? Which ones are going to expect growth? Well, materials is going to do well. There's going to be, gold prices are up and there's an increase of about 7%. We're expecting there in metals and mining. Healthcare. Healthcare is going to be big, 6.6% growth. And it's going to be led by life sciences, tools, and services. Remember, services in the life sciences sector. Consumer staples, they're expected to increase 2.3%. And which sectors are going to drive consumer staples? Food and household products. Why? It's the COVID trade. People are at home, they're baking more. People are buying more household stuff because you know what? They're home. They want to buy stuff. Finally, tech sector earnings are expected to increase about 1.7%. Now, finally, I want to talk a little bit about guidance. Okay, so you're going to hear a lot about what matters here. It's earnings, earnings, earnings. I would say for the first time in a while, put a little bit more weight into guidance. We all know that every time a company releases earnings, they're going to give you some guidance. We expect this. We have guidance for 2021. We expect future revenue, future top line number to be X. We expect earnings to be X. And the tone that management is going to use in their earnings calls and in their press releases, to me, is probably more important than the earnings themselves. So we're expecting, worsening coronavirus trends. We expect restrictions. We expect slower vaccine. So that's now flagged as potential risks to the consensus expectations for the earnings to increase. Okay, so we had predicted some sort of increase of about 16.5%, and these are the analysts as a whole. And now the previews are being discussed as to how the guidance is likely to matter and how the guidance might change that. So 23% earnings growth is still the number that the FactSet expectations are for earnings growth in 2021. So are we going to see that? I think the guidance is going to tell us a lot. Companies are going to report fourth quarter. They're going to tell us, here's what we expect. Here's what we see. Here's what we think is happening. Listen to that, learn, and adapt. as you hear that, as you hear the earnings. And if you're not sure, by all means, please go to www.speaktorob.com. We'd love to book a no obligation consultation with you to chat about your investments and how these earnings fit into your portfolio. Are you exposed to the right sectors? Do you have enough global US exposure? My guess is probably not. Anyways, guys, thanks for tuning in. Take a sec to subscribe. Press the red button on your YouTube. Just press it. Subscribe, like, share, tell all your friends about us. I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management. Thanks for tuning in. Have a great day.